So hello now, good afternoon. I welcome you right before the prolongated Easter weekend today with this special webinar, how to trade the market opening of the US markets. So yeah, let's in fact see whether there will be a trading opportunity at all, due to the fact that we should expect volatility to come down before Easter now. In fact, it's slightly, let's call it different. Yeah, it's in fact it's a little different here with the U.S. markets compared to the German markets. So tomorrow the U.S. markets will be off, but will then restart trading on Monday already, while in Germany this day is off too. So we have something we call Easter Monday, to be honest. So just let me send an email here, a short message in the chat box on YouTube here. And yeah, so what we want to look at is how a setup could look like, how to trade the US market opening, and then let's just see whether the setup is triggered or not. What I can say so far is that the overall price action during European trading hours. Oh, by the way, I'm sorry, I just skipped the next slide here. So the definition of the open range setup is already something I want to bring up here, even though, first of all, let's focus on the European markets and what they, or how they perform currently. So in fact, we are coming in quite bullish into the trading day in the European trading markets. So here's a look at the DAX. And so as you can see, we are steadily bid right from the open at, in this case here, 6 a.m. GMT, and made it back above 12,000 points, something which I in fact expected already. I talked about this in the morning meetings here. You can follow these events at 9:30 a.m. GMT every day. Yeah, in fact, it's every day in the YouTube channel from JFD Brokers. And yeah, what I can say so far is that the market has not disappointed in terms of my research. In fact, yesterday, everything went a little unlucky, let's say. So I closed out a trade, break even. And I was in fact long yesterday, and I was expecting the move we get to see today at least towards 12,000 points, if not above that level. I expected this already to happen yesterday. So I wasn't that unlucky that I was on the long side or positioned on the long side. First of all, when we started the day out, that was, sorry, where is it here? Yeah. In fact, we sold off, not aggressively, but nevertheless, the market lost some points here, made new, not necessarily weekly lows. No. We didn't attack the levels here from Monday, but we saw some selling pressure, and then the market stabilized. And I became skeptical once the DAX didn't make it significantly to new lows here, and then started to trade higher from there. I made it back above this blue line, this exponential moving average 50 on a 5-minute time frame, and started to trade higher from here. And then with the US market opening, so till here, nothing big happened. So I was positioned on the long side based on my entry logic, and everything was fine. And then the market opened bullish in the US equity markets. Let me put it here. Open bullish means we saw some buying happening here. That was around this time. So between 1:30 and 2 p.m. GMT, and the market pushed higher from here, but saw some selling pressure, even though you can see that the market presented itself yesterday in US equity markets quite choppy. But after the losses of the day before, it was a solid start into the trading day, let's say. It was okay. So it's not that the market took on further momentum on the downside, but stabilized a little. And this resulted in the DAX to push to new intraday highs yesterday. That was here. And that let me come to the conclusion that probably makes sense, also based on the current pressure we saw then the day before on Tuesday in the technology sector here in the US, that probably it's better to not being, let's call it, surprised on the downside. And after the market moved already around 100 points in my direction, that it's okay to trail the stop to break even, and then just let's see. So in fact, I planned already yesterday to take the last position for the week because of the prolonged Easter weekend. So that was a decision I took already at the beginning of the week, if not already in the week before. And so yeah, then the market showed some momentum again here on the upside. I trailed the stop to break even, which was somewhere in this region here, and then we saw this quite sharp drop. So the market, in fact, the DAX here gave back 100 points, presented itself very choppy, and I had to say, well, I don't want to be positioned long here anymore at all, and was not just stopped out break even, but didn't intend to take on another position, since it seemed as if the pressure coming from the technology sector does not continue. That the pressure continues yesterday then. And then something, let's call it unlucky or unfortunate, happened. The market pushed higher, made new intraday highs, even though due to the choppy price action in US equity markets, traded quite stable, even though with some gains for the trading day out of the day. So what I would have done, in fact, and by the way, let me just show you something. 1 second. So that you have an idea. Unfortunately, it's that I only have this research piece available here in German, but you can already see in the header from in the morning here that I'm obviously here seeing the DAX, if you translate this into English, with a chance to close the trading week then and close before the Easter weekend here above 12,000 points. And that means nothing different than if I still had a position, which unfortunately I didn't, I would have probably migrated this position into this trading day now, and taken out, in fact, the system. I usually trade in the DAX, so it's an automated system, which is generating a positive expected value over a time span of something close to 20 years. And here, I then try to optimize the expected value, make the strategy, if you want, even more profitable. And so based on that, the thing is that that I really said, okay, this strategy will be short today, and I don't want to be short before Easter because I don't see many chances volatility to rise significantly, pressure building, even though, I mean, there's still a chance that this will happen. Nevertheless, it's something where I say, okay, it's probably not that likely. We'll now see during US equities opening, respectively, US markets opening, and then in the upcoming hours, whether there will be some pressure building. But all in all, I was, in fact, already taking a position here. So let's call this a discretionary touch. Yeah, again, as you can see, I would have probably migrated this trade then into the next trading day if it wasn't taken out here. In fact, probably it's also a very, very solid approach, because you have to make sure that you understand, if I'm stopped out here at break even and we're closing the day then somewhere here, something like 100 points higher, you have quite a solid room between the current market price and your stop level. So not facing any big issues or trouble in terms of potential slippage occurring when the market opens with a gap and all this. And yeah, unfortunately, as you can see, the market is building this momentum. And currently, it seems likely somehow that we already make it to this quite significant resistance region here around 12,130, 160 points. So even though we are talking about US market opening, nevertheless, I just want to give you an update here on my main traded asset, which is the DAX, in fact. And yeah, so far the picture looks quite bright, let's say, and we have some good room on the upside up to 12,130, 12,160 points, at least, if we not make it to this level and there's not real big pressure building in US equity markets, then we'll make it at minimum above 12,000 points out of the week and into the Easter weekend. So with this said, you can already imagine that my outlook for US equity markets probably not that negative. Respectively, I think it's quite solid what we can expect. So in the Dow Jones, for example, At the beginning of the trading week, we saw some, let me just see here. Yeah, we saw a quite strong reaction, in fact, against this region here. Around this blue line, which is the 200 simple moving average. The interesting thing about this is that this candle in the Dow Jones, this deep green candle, looks completely different to the one we've seen in the DAX at the beginning of the trading week. So in fact, this is the candle in the DAX, even though we can see that we significantly made it back from these lows, in fact, current yearly lows, and then closed the day in the green. But that candle alone already showed that there's some willingness of the bulls to at least fight further downward pressure from the bears here. And that was already a strong signal, even though the price action on Tuesday then, came with a surprise. So I myself was really surprised to see that the Dow Jones here presented itself that weak, mainly induced by the technology sector, and also mainly induced by the so-called FANG stocks. So FANG is short, is FAANG. It's short for Facebook, Amazon, Apple, Netflix, Google. And by the way, Google today is Alphabet, but nevertheless, we still refer to it as Google. And but it wasn't capable of really pushing the markets significantly lower here. Now the market seems to stabilize, and all in all, with expected volatility, or volatility to be expected to drop here and diminish before the weekend here, I think that there's a good and solid chance that probably we'll see at least a drift on the upside here, and no real significant selling pressure building once again. Even though, again, you should keep this in mind that there is a serious chance that something like this could happen. And if it happens, well, or this is the thing, that reason alone brings me to the point where I say, well, I see the advantage on the long side, even though I think I definitely prefer reducing the position size in general. So let's work with a number here, an example. Let's say we are normally risking 1%, and then we say, okay, we reduce the overall risk of 1% down to 0.5. So that gets the job done, and is d'accord with the current situation in the markets here, and how the markets present itself before the Easter weekend then. So yeah, that said, let's come to the S&P 500 here. So by the way, that's good that I haven't prepared yet. So what I want to show you is, sometimes probably some people might wonder, what are these horizontal lines here? What are these vertical lines? Let me just guide you through this. So what I do is I look at the main trading hours. This is when, let's put it in a very simple way, when Wall Street is open. And this is usually between 1:30 p.m. GMT currently and 8 p.m. GMT. So that means that this is the window during which you should expect volume to be high. Okay, and so yeah, with this in mind, this is something which I make visible with these vertical lines in this case. So what I do is I in fact trail this over to 1:30 p.m. GMT. So in fact, you can see here it's 15 or 3:30. This is German time, and then move this one here to 22. So if you subtract 2 hours from here, you can see that you're at 1:30 to 8 p.m. 1:30 a.m. 1 second. 1:30 p.m. Sorry, 1:30 p.m. till 8 p.m. GMT. Those vertical horizontal lines, the green one and here the red one. These are, or this is here the low of the day before, and this one is the high of the day before. So the green line is the low, the red line is the high of the day before. Then we have this blue line here, which is the close of the day before, and the turquoise line will be the first tick at 1:30 p.m. GMT. So this is the, if you want, the spot open of the market. And this yellow line here is the exponential moving average 10 on a 15-minute time frame. This is our trend filter, which where it will become obvious what I do with this. So one just. One second here. Okay, perfect. And so, and that's it, in fact. So this is how my intraday picture looks like. And based on that, you can now formulate a potential trading setup. And therefore, let me just show you this slide here once again. So these three points you have to work through to formulate a trading setup then. So definition of the open range breakout setup. And first we define the open range between, in this case, in fact, I have to change this. It's and now we have summertime in Germany. So what we need to do is 1:30 to 2:15 and adapt it accordingly once in something like 6 months from now. We go back here to the let's call it winter time or something like that. So if we bring back the time here, for example, in Germany, 1 hour back, so then we're back again at 2:30. But in this case, it's 1:30 p.m. to 2:15 p.m. GMT. This is the open range, which we have to define. Then we identify the advantage based on the 50-minute exponential moving average, meaning nothing more than if we trade above that, we are only trading the long side. If we trade below that, we are only trading the short side. And then we trade the breakout of this range in direction of the identified advantage, meaning if we are trading above the 15 exponential moving average and we're breaking out on the upside, we're going long. If we are trading below the 15-minute exponential moving average 10 and break out on the downside, we trade the short side. And then we place the stop above, respectively, below the high, low of the range. And there we go. That's in fact the setup. And again, nevertheless, the range, we have to wait the first 45 minutes of the trading day until we are having such a range. And therefore, now let's give you an example of how this looked like yesterday. So in fact, yesterday was a horrible day, obviously. So no trending action at all. And now you will see also on Monday, no, I'm sorry, on Tuesday, you will see even if the market trends does not necessarily mean you're profiting from this, which is where trading psychology comes into play and where the aspect comes into play where you have to, where you have to be mentally stable, let's say, and don't go nuts after you see such a development happening. But first of all, let's have a look here at this case from yesterday, where obviously this range, and therefore let's use those two, let's call them pink lines. Okay, and so this is the high of this range, obviously. The first 3 50-minute candles are obviously summing up to 45 minutes. And then you have also here a chance to see the low of this. By the way, let me just see. The low is 602. This is not correct. So you can see the low here. It's here. So there you can see it. There's the low of this candle. Yeah, so what happens is the following. The market is obviously trading below this really short-term exponential moving average here, and then breaking out on the downside with this candle. So this is where the setup is triggered at 602. You place the stop here above this line. And then you can see that the market does not see a aggressive follow through on the downside, but in fact is trading back, and here we're getting stopped out. So once the market goes up to new daily highs, in this case intraday highs, you're stopped out here. This is then a loss which sums up to 2,602. This is where the low is, and this is 2,624. So it's something like 22, 23 points. you have in fact to calculate the position size accordingly. That makes sense, right? So that means if you're saying, let's say I'm trading, let me just do this with an example here. A second. So here's the SPX open range, and you say it's 602. Let's work with a rough example. So I'm not working with decimals here. So then it's 23 points, obviously. And let's assume you're trading a 10,000 euro account, and you're risking 1% per trade, which equals to 100 euro. So from here, you're obviously dividing those 100 euros through 23, and then you get a number slightly above 4. So it's 100 through 23, 4.3 in this case. And well, that's it. So that's the position size you're using here. So you can see that it doesn't really matter how big the range is. The only thing you do is based on your on the risk you're willing to take, you're then you're then calculating the number of contracts you're willing to trade here. And in this case, then it means nothing more than if you're trading this range here with 4.3 contracts, such a stop out means a loss of 100 points. So now let's go to the example from the day before. Let me just copy paste this here first to have a similar picture. And they say the high is 670 then. So this is again the open range of this trading day. 1 second, I just made a mistake here. 670. Oh, I'm okay. I thought that was an 8, but it's not. So it's here. So this is the open range of the trading day on Tuesday. And what you can clearly see is that once US technology stocks sold aggressively off here, that with this sell-off, you see a trending market. And let's assume you're positioned on the short side. Well, then obviously you're making a nice profit on such a trade. If the market really keeps if the market really sees such a big pressure, then you're building. By the way, let me just see. Low 60. Yeah. So now the problem is that you're triggered here on the short side. You can see this. There's a small spike occurring here, there, respectively. If not here, then it's the next candle. You can see that you're triggered on the short side, and you're placing your stop above the highs, as mentioned here in 0.3. So trade of the break in direction of the identified advantage. We were trading below the 50-minute exponential moving average 10, and we placed the stop above the high of the range. And in this context here, you can see that this stop is triggered only to see then the market collapsing on the downside shortly after with the drop in technology stocks then in the Nasdaq. And why do I show you that? Because it perfectly illustrates not just a market environment in which you don't see good market conditions at all, but it's also because you can see here that sometimes it seems as if you're making a great trade on this, even though you're getting unlucky sometimes, stopped out before only to see the market collapsing afterwards. So if such a something like this is happening here, well, this is the moment then where you really start to probably question the approach. Probably it only takes one trade. And there you can see how important it is to have not just a solid based plan, a setup which you're trading every day then, and which you're trusting, but also that you're focusing here on visualizing how the performance was, or how the strategy performed, how the setup performed under different market conditions. One second, where is it? I just have to see where. Oh, I'm sorry. Here's the chart. So the thing is that some people probably come to the following conclusion. So what you usually do is that you then question if the approach is really profitable. And what you plan to do is then, okay, yeah, probably take out the stop, or don't work with the stop at all, but only not with a so-called hard stop, but work with a mental stop, something like that. So not having a stop placed at the server of your broker, for example, but instead placing a stop then in your head, in your brain, and saying, hey, if this level is reached, well, then I take out the trade, only to avoid getting stopped out here, because you now come to the conclusion that such a stop is probably too tight, and it's avoiding you gaining a profit out of this favorable market conditions developing then here. So while I say that, the thing is that this is far from the truth, but also, or mainly something which in trading psychology we call cognitive bias here in this case. And why do I say that is the following. So what you can clearly see is that even if you work with those parameters, and from time to time you see such an unlucky event happening where you're getting stopped out, and then see in the market moving aggressively in direction. And by the way, remember what I just presented to you at the beginning of this webinar here. So what did I tell you was that I was stopped out yesterday. And by the way, here the DAX is heading higher, and most likely reaching 12,130 to 160 points probably, if in fact the US equity markets perform well today. But if you're getting stopped out here, this is something which is causing some pain, let's say, and you're looking at chart and really it's like, wow, is this necessary? But this is my reaction to this. So I'm quite neutral. I try to be as objective as possible. The main reason for that is because I know that the strategy which I'm trading here is part of this so-called basket. We have a basket investor strategy. Right? 1 second. So, and what I know is that the overall performance of this strategy is obviously profitable. So this is the account balance. We want to have a look at the overall profit. So what you can see is that even if I'm getting stopped out from time to time here, break even, the overall performance is solid and clearly upwards. So what I mean by that is that having such, this is something which it happens. It happens. This is what I want to say, and this is also true here for the S&P. By the way, did I save this? No, I didn't. Oh, that's not unfortunate. But you remember here. So this is where we got stopped out, and then seeing the market moving aggressively in our direction based on the setup. And so now the thing is, and there's where such a solid backtest comes into play. It's obvious that it doesn't change the overall profitability of this trading approach. So meaning nothing more than even if you have such a cash-ins, and if such a losing trade occurs, which is again normal, nevertheless, it does not mean that here in this context that the overall profitability is hurt by that. But in fact, the equity curve keeps on rising no matter what, and it's still a profitable approach. Profitability, by the way, it's something I probably should introduce here. So what is profitability meaning? It's the expected value, average gain multiplied with the hit rate, and then you subtract the average loss with the loss rate. And if this number you're getting here is bigger than 0, then you have a positive expected value. And yes, so in fact, that's it. So and this is exactly what it's all about in trading, in fact. So trading is about to trade with the so-called positive expected value. And this is where, for example, a basic strategy comes into play. I talked about this at the beginning. So in fact, when looking here at these parameters, you obviously have only probably half of it. Because the thing is that if you carefully watch, you can see that there's no take profit level mentioned, not one. And the question is, so where do we take profits? And in fact, this is a very, very crucial question here, meaning that if the market moves to a certain level, then probably it makes sense to take out the trade, to take profits, to cash in the chips if you want. And this is something which is also possible to automate here, because the picture I've just shown to you here, this graph of this backtest we ran, it takes out the trade automatically currently at 7:50 p.m. GMT. So that means you're not cashing in the chips at all, but you only wait for this time to happen, and then you take out the trade if it's not stopped out, in fact, in meanwhile. And that's it, in fact. So and this is exactly where my approach comes into play, because now I say, okay, this is an exit, a way to exit the trades, which is something to go after, because we know already it has a positive expected value, even though what I try to achieve is to somehow increase this expected value. Or put it differently, while I don't expect me being able to increase the hit, respectively the loss rate, I think that with deep market understanding and knowledge about the market structure, that we can influence the average gain, respectively the average loss here. Yes, so in fact, that's it. So that's what I'm aiming for. So what I try to is, for example, get a little more aggressive with my stop, just in case I see the market moving towards a very significant support, respectively resistance zone, while on the other side, the average loss here could be reduced with techniques we could call scale out, for example. So taking out a position which does not move in our direction, probably we have a very detailed trading journal, for example, which is giving us a chance to also work with something we call time scale out. So then we could say, if a market has not shown a positive a result after, let's say, 30 minutes to 1 hour, well, probably 1 hour, then we take out half of the trade, because chances increase dramatically that we are not seeing a positive outcome of the trade. And if you do this in a very effective way and a continuous process and over again, then chances increase dramatically here that you can that way effectively decrease the size of the average loss. And in fact, that's it. Yes. So that's it when it comes to optimizing the expected value. By the way, I just want to see whether some questions came up. Okay. What do I trade? It's the S&P 500. So it's the, 1 second, please. Let me just see here. I just hope that I do not have some internet connection problem. So here at my end, it unfortunately takes a little, and in fact, a little too long to load the website. Okay, so that's fine. Okay, perfect. Yeah, so I don't see any further questions, in fact. So now it's running again. So it's only which markets I trade, respectively here, which markets I'm looking at right now. So in fact, we are waiting for, in fact, we have to move this turquoise line now to the first tick. So this is, as you can see here, the first tick of this green candle, current green candle. So we are looking at the S&P right now. At the beginning of this webinar, we are looking at the DAX, but, and this is the thing, in fact, we can't formulate a trading setup within the next 35 minutes till our setup says that we have to wait till 2:15 p.m. GMT here. We have to wait till this time to come, that we have a high and a low here, and then we have a range, and we trade the breakout out of this range, depending on which side and where we are trading in relation to the so-called 50-minute exponential moving average 10 here. So this is our filter in this case. Are there any further questions? Else it's getting really difficult right now because, and this is the thing, so something which I'm really happy about. Do you trade the S&P isolated? So you mean, so what do you mean exactly by that? Isolated? So you mean if I'm only trading the S&P, or if there are also other assets I'm trading? If the question is if I also trade other assets, yes, I can already give you an example here. Again, this is something you can see here via FX Blue, via this let's call it the performance tracking software, which is giving a very good overview of the basket we're trading here. And so what you can see here is all the different asset classes we're trading, respectively different assets. It's the DAX, it's the Dow Jones, it's the S&P 500, and so the thing is that you can see here, by the way, if you click on stats, and if you click on the symbol plus direction, sim plus dir, what you can see is all assets, and then it's it shows which direction you trade. In this case, US 500 here. So you can see this tracking started 1 month ago. 1 month ago, at the no. 1.5. It's 1.5 months. So it's the 16th, 19th of February, if I'm not mistaken. And you can see here that this is obviously also a strategy which is traded here within the basket. And so far, it's running nice. So it's not a huge profit, but it's obviously a profitable approach, as you can see here. So the hit rate is close to 50%. In fact, it's 20 trades. I'm sorry, 40 trades, 20 winners, 20 losers. So it's really 50%. And the great thing about this is that here you can see the average gain and the average loss. And you can see that in case of winning, you're making more than you're on average lose. And this is the same is true for short positions here. So these two lines here are showing this. So with a hit rate of 50%, you're obviously profitable. And this is thanks to the knowledge of this formula, since if the hit rate is 50% and the loss rate is 50%, you can only make money by making on average more, as in the case when you're losing. That's it. And so this is then creating the positive expected value here. So in fact, this is no guarantee that our performance will be profitable in the future too. And this is exactly the thing. So the target here is to manage risks accordingly and weigh the strategies accordingly in this basket, for example. So make sure that the overall risk per day, for example, on all 8-9 strategies we are trading here is not going significantly above 1%. And so by that, you can, you give yourself the room to be wrong. This is, by the way, something which sounds a little funny right now. But the thing is that I really believe by that, I really live by that approach. It says, allow yourself to be wrong. Okay, that sounds weird at first, but this is exactly the thing. So many traders out there, retail traders especially, are not focused on, are not really focused here on allowing themselves to be wrong. But they just think, for whatever reason, that they will be right all the time, and there are no losing trades. So it's an illusion. It's a competence illusion. You call this in the behavioral finance. And so the thing is then that here it's not unusual that retail traders trade with aggressive and high leverage in their trading. You can find them trading with this. And so when trading with high leverage, it means you're trading with a position size which is, compared to your account size, too big. This is something we call a high effective leverage. It does not allow you to be wrong here, but it increases, in fact, the chances to be a long-term loser, being unprofitable in your trading. And therefore, let me just show you a chart. I just have to see whether I can find it right now. 1 second, please. So one sec, it just takes a little. Okay, so let me just see. Yes, there we are. So this is data from a third-party broker. And nevertheless, it perfectly illustrates what I just said. So what you can see here is that during the time span which was analyzed, you can see here on this x-axis here, higher 25 to 1, for example, between 10 to 1 to 25 to 1, and so on. And here, less than 5 to 1. That you get to see such a graph here. What does it mean? It means that during the analyzed time span, in 80% of the cases, only 18% of the traders here were profitable when trading with an effective leverage bigger 21 to 1. So what is the effective leverage again? So it is, in fact, here defined as effective leverage as the position size you're taking. So position size means, for example, if you're trading, let's say 10 DAX right now, 10 DAX CFD, you can multiply this 10 with the current index reading, which is nearly 12,000. So this then comes out at 120,000. And you divide this number, 120,000, by the account size then here. In fact, if you're trading a 10,000 euro account, for example, account size, if you're then having a 10,000 euro account, for example, that means that your effective leverage is 12 to 1. So that means, example, again, index CFD, index reading is 12,000. I'm sorry, 12,000. Then we are going to 120,000 in terms of position size. And if the account size now is 10,000 euros, 10,000 euro, then you get an effective leverage of 120,000 to 10,000, which equals 12 to 1. There we go. So that's how you can calculate your effective leverage in each market and compared to your account size. And so what I just referred to was the thing is, if this effective leverage is too high, in case you can imagine that many traders here were trading with a small account, try to compensate here via the leverage which is offered by the broker, then to trade bigger and try to achieve a higher return. The only problem is, if they are wrong, they can't be wrong that often, if they can't be wrong one time at all, if not going all in here with their trade. And this is something which does not allow them to be wrong here on such a trade. And so in fact, that's something which you should carefully consider when trading, in this case, trading the markets. So one second, by the way, let me just go back here to the questions. And yeah, so in fact, that's nearly it, what I just wanted to say. So allow yourself to be wrong. I just lost a little the reason why I came up with this, but yes. So I think you get my point in this case. So let me just then close this chart again. Okay, and let's come back here to the questions. What are my projections for next week. So all in all, it's in fact, and this is the thing, I'm in fact very short-term oriented, which means I can give you an idea of what I expect, for example, for my main traded asset in this case, which is the DAX. What I expect for it. So I think the DAX has some room, even though right now some selling pressure is building. It still has potential, and I think it's likely that we'll close the week above 12,000 points here. And then the thing is that I say 12,130 to 12,160 is something which is achievable. Even though I doubt that we have so much potential here, making it up to 12,470, 12,500 points. And this is mainly due to the reason that there are many US data sets coming out. And I currently consider especially equities to be in a classic lose-lose situation. Why do I say that? Well, the thing is that if the data comes out above expectation, there's a chance that yields keep rising. I'm not sure whether you probably have seen the current rising or diverging dollar LIBOR OIS spread. I don't want to go into too much details here, but it's an indication of at least how the credit markets probably see some liquidity issues, let's say. And this is something which could weigh on the equity markets rather sooner or later, since this divergence is aggressively rising. So therefore, let me just see whether I find the chart for that to illustrate you this idea. Oh. Okay, for whatever reason, sometimes it just doesn't work the way it should. So there we go. Let me just see that. Okay. So dollar, LIBOR, OIS. Okay. So I'll come up with a chart in a few seconds here. I probably close this window here. And let me just see whether I can close other windows, which are, for whatever reason, causing some difficulties here. There's another question on the DAX, what I think about scalping the DAX here on a 1 to 5 minute time frame. It's not my trading approach at all, to put it that way. So in fact, I haven't met many traders which can actively trade such a time frame here and be profitable in the trading. Oh gosh. Well, there we go. So hopefully there will be a picture in a few seconds. So there we go. So here you can see the LIBOR OIS. And for further explanations on the LIBOR itself, respectively OIS, it's probably useful to work with a website like Investopedia or something. Just Google it. So the short version is that the LIBOR is the so-called London Interbank Offered Rate. So this is the rate at which banks offer liquidity, respectively short-term loans overnight, respectively over any time frame. So for example, you can see 3 months is also possible. At least we call this short-term liquidity to each other. While the OIS, the overnight index swap rate, is showing the so-called risk-free premium, which is offered by the central bank of, let's say, the Eurozone, ECB in this case, or the Fed, for example. And those OIS numbers here, overnight index swap rates, are also from time to time brought up to show how likely the swap markets here, which play in fact a very important role in the FX markets, how likely market participants consider a central bank to hike rates than here in the upcoming so and so months, depends on which number you look at here. And now the thing is that usually those two numbers, LIBOR and OIS, usually trade within a very, very narrow spread. But if especially uncertainty rises in the markets and the credit market sees some liquidity crunches, for example, especially true around the financial crisis in 2008, for example, the OIS spiked aggressively higher. And this didn't happen for quite a while now, but what you can see is that from the beginning of 2018 onwards, the LIBOR OIS spread started to widen again to, in fact, the highest levels for at least the last, I'm not sure, 5 years, 6 years, or something. And this is showing some potential uncertainty building in the credit markets, potential credit crunches forming here. And so, in fact, one driver could be that market participants are right now see markets recalculating or repatriating or whatever their portfolios based on the Fed hiking rates, short-term rates especially. So what you can also see is, for example, when looking at the spread of 2-year and 10-year U.S. Treasury yields, you can see that the spread narrows even further, which is usually a sign that market participants, on one hand, expect short-term rates to rise, while they expect long-term rates to fall. And that way, you see a so-called flattening yield curve, which is usually an indication for potential recession in the U.S. in this case forming. And so the reason I mention that is because if, in this case, numbers come in above expectation, it makes it more likely that the Fed keeps on rising rates, which usually should result, if short-term rates keep on rising, that this spread widens even further, credit crunches become more likely. This could weigh more heavily on the DAX, respectively on equity markets in general. While on the other hand, I say, well, what if numbers come in below expectation? Well, this is then definitely something to worry about, because bad numbers in combination with the Fed hiking rates, and it's at least another 2 hikes in 2018, which will happen, while, for example, the ECB probably also starts not just only to reduce their asset purchases, but potentially looking for hiking rates then in the future, respectively. For example, also there's speculation around Shinzo Abe not making it as the prime minister of Japan any longer. So there's some rumors building, which could also be the end to Abenomics. If we combine all this, potential restrictive central banks, while economic data is not what's the word for this? While economic data is not positive anymore, well, what you can see then is that usually in both cases, numbers coming in better or worse than expected, that probably equity markets will sell off on such news. And this is something where I say short term, I see chances to be given that probably the DAX can continue with this current momentum at the beginning of next week, after the prolonged Easter weekend, but then probably see a push lower if data comes in at whatever number, but in both cases not positive for equity markets at all. Yeah, okay. I just hope that this answers the question here. And yeah, so in fact that's it from my end. So we are at 2 p.m. GMT right now. So this is the end of this event here. Again, what we have to wait for is the range to be defined here, which means we have to wait another 15 minutes until we have a significant and tradable low, respectively high within this range. So far, it seems as really if we are breaking, if we are forming such a range here, and if we're trading then below this yellow line and break out on the downside, we have a short trade. But again, I'm not very positive, especially for short trades today, right before this prolongated Easter weekend. That's one of the reasons why I reduced the position size in such a case and probably cut it in half or something, not risking, let's use numbers here, 1%, but instead then 0.5%, for example. So that's my suggestion. And yeah, I hope that you enjoyed this webinar. I wish you all the best. Happy trading, happy Easter, and I'll talk to you again then next week on Thursday. I definitely look forward to it. I wish you all the best. Happy trading. Watch your stops. Take care. See you. Bye-bye.